This chapter covers stockholders' equity, and we're going to start off by revisiting some of the things we talked about in Chapter 1 about corporations. So we've been talking about the corporate form of business all throughout the semester. And so in Chapter 1, we covered how a corporation was a legal entity, legally separate from the owner of the business. That distinguishes it from a sole proprietorship, where the owner is the business. And so a corporation can acquire property in its own name. It can enter into contracts. It can sue and be sued. And so the shares of ownership of a corporation are called stock, and the owners of the corporation are the stockholders. And then, I don't know if we covered this, we'll cover it now. What a public corporation. So a corporation can be a public corporation or a privately held corporation. A public corporation, their stock is traded on a public stock exchange. And here are the two biggest stock exchanges in the United States, New York Stock Exchange and NASDAQ, where a lot of the tech stocks are traded. And so a privately held corporation is a corporation where the stock is not traded on the public stock exchange. And so if you started your own business, you may choose to incorporate to take advantage of that limited liability. You would not be trading your stock on a stock exchange, so you would be a privately held corporation. And so if you're a privately held corporation, you don't have to show anybody your financial statements. You just have to provide them to the IRS when you're filing your tax return. But other than that, that's your business. And the only time you would want to show somebody your information is probably when you're going to go and ask somebody for money, either when you're bringing on an investor or taking out a loan. And so we covered this back in Chapter 1, the biggest advantage is that limited liability. Since the corporation is its own legal entity, that if the corporation is being sued, it's only the corporation's assets that are at risk. If the corporation goes bankrupt, it's only its assets. You can't go to the stockholders and have them settle the debts of the corporation. So as a stockholder of a corporation, the most you can lose is what you paid for the share of stock. Disadvantages, we talked about Sarbanes-Oxley, that publicly traded companies have to be in compliance with. Double taxation. Since a corporation is its own legal entity, it will file its own tax return, pay tax on its taxable income at the corporate level. And then if it distributes earnings to shareholders in the form of dividends, so that's part of the income that was taxed at the corporate level, the dividends are also taxable. So if you get a dividend from a corporation, you have to report that on your Form 1040 and pay tax on that. So when we form a corporation, you file a certificate of formation with the state. And so many corporations organize in Delaware. It has very favorable laws for businesses. And so even large corporations that are headquartered, the headquarters are elsewhere in the country, they still go to Delaware and incorporate. And you have to file articles of incorporation with the state. So that's kind of forming the contract with the state, getting permission for how you're going to conduct business in the state. A couple of things that we're interested in from the articles of incorporation is the authorized shares. We have to ask for permission for the number of shares that we want to issue. And this authorized share amount in your articles of incorporation is the maximum number of shares that you're allowed to issue as a corporation. So when you file your articles of incorporation, you're going to ask for a lot more shares than you need. You have to allow room for growth, because once you reach the authorized shares, you have to go back to the state and get permission to issue more. And the articles of incorporation will also state the par value. This is the arbitrary amount used to record the common stock. This is what we're going to use to determine the amount that goes into the common stock account. It used to be that the common stock held the legal capital for the business, so it was more or less kind of setting aside funds for the shareholders if there was liquidation of the company. But now corporations set their par value very, very low. It might be a penny. It might be a fraction of a penny that they're setting as their par value. And the par value in no way has anything to do with the market value of the stock, because the market value is determined by the economic conditions of the market. What are shareholders willing to pay for your share of stock? The corporation doesn't set the market value. Some other definitions of stock. Issued shares are shares that have been transferred to shareholders, and that's usually going to be done through sale, right? That's the point typically of shares, is we issue shares of stock because we need to raise money, so we sell shares of stock. Outstanding shares are shares that are still out there in the hands of shareholders. And so a lot of times your issued shares and outstanding shares are the same. They will not be the same if there are treasury shares. If the corporation goes and buys back shares from shareholders. So they were issued shares because at one point in time they were in the hands of shareholders, but they've been bought back. So they're not outstanding anymore. They're being held in the treasury by the corporation. So rights of stockholders. If you will have one class of stock called common stock that has the right to vote. Has the right to dividends if they're being declared. Liquidation, after the creditors are paid, then whatever assets are left will be used to and be distributed to shareholders. A preemptive right, if additional shares are being issued, that they give the existing shareholders the opportunity to buy the shares first, so that the stockholders have the choice to maintain their ownership percentage in the company. So classes of stock, common stock, all companies have common stock. All corporations have common stock. This is a class of stock that votes. And you can have certain classes within common stock, and some of the classes may have more, votes than other classes. But that all has to be set up front at the time you're issuing the shares of stock. So the other class of stock is preferred stock. And so preferred stock has a preference for dividends. They are going to get a set amount every year in dividends, and they will receive their dividends before the common stockholders can get any dividends. And so an investor that buys preferred stock is going to have a different investment strategy typically than someone that's investing in common stock. Usually in common stock, for common stockholders, those investors, they're looking to really, get a return on their investment through capital gains, because they buy the stock at one price and then they can sell it later at a higher price. That's where they're looking to really make their money. As opposed to the focus being on dividends. Of course, some do choose a stock where they're going to get regular dividends, so they have that income stream as well. But preferred stockholders are going to be more reliant on the dividends as their income stream. So our paid-in capital, our stockholders' equity is going to be broken down. Our paid-in capital is also called contributed capital. This is the amount we receive from investors in exchange for common stock. So that's what we're going to be recording there. And then our retained earnings, we've learned this since the beginning of the semester. Our retained earnings is just what the name says. It's the earnings that the company is retaining, that it's keeping in the company. So your retained earnings is your net income minus your dividends. Another term you might have heard is initial public offering, an IPO. If you ever watch the show Shark Tank and you see the sharks are investing in companies or giving them money for their startup companies, and a lot of firms, they're called angel investment firms, they find companies that have good ideas and they give them money to get them to grow their company and to take off. And their hope is that eventually they can go public, because that's when they can really make a lot of money. They have their IPO. So when you have an IPO, that means you're going to be selling on a public stock exchange. And when a company decides to have an IPO, they will get an investment bank like Merrill Lynch that will help them. They will be the underwriter, and they will help them line up investors to buy the shares of stock with the IPO. And so this is the only time that the corporation ever sets their price with the IPO, the first time it's being sold. They will line up investors that are willing to buy the shares at a certain price. And then after that, then the market decides. Then those initial investors, they can be trading those shares on the public stock exchange. So from the accounting side, when we're recording a stock issuance, we need to know the par value, right? And as I said, the par value is going to be different than the market value, right? Because especially the par value is set very low. If the par value happened to be the same as the market value, that would just be a coincidence. So typically, stock is being issued at a premium. It's being issued at a price higher than par. And so the excess between the par value and the market value that you're receiving when you sell your shares of stock is recorded in an account called paid in capital in excess of par. So we have a new stockholders equity account that we're learning about in this chapter. So when we sell shares of stock, right, we're selling stock to obtain cash. So we debit cash for the amount we receive from selling the shares. So take the number of shares times the selling price. That's your debit to cash. Common stock. Whenever you're dealing with the common stock account, you will take the number of shares and multiply it by the par value. And then the difference between the market price and the par value, that difference goes into the paid in capital in excess of par common account. And you'll have a paid in capital in excess of par for your common stock. You'll also have one for your preferred stock. So if you're issuing preferred stock, it's going to be done the same way, except your credit will be to preferred stock. Number of shares times par. You'll credit paid in capital in excess of par preferred. Okay. So let's say we issue 10 shares of $2 par common stock for $5 a share. So we're selling at $5 a share, 5 times 10. We will be receiving cash of $50. We'll credit stock for the 10 shares times the $2 par. We'll credit paid in capital in excess of par common for the difference, right? So our credits add up to 50. We got a debit of 50. Typically, you'll be issuing your shares of stock for cash, but there may be a situation where you issue stock for something other than cash. Particularly if you're a startup company. You don't have a lot of, you don't have a lot of cash, so maybe you'll get your lawyer instead of, paying their bill. Maybe you'll, pay them with shares of stock. Maybe you'll buy equipment with shares of stock, right? If you're a startup company, maybe you'll be able to convince whoever you're doing the transaction with that, hey, this company's going to take off. This is going to be worth way more if you take in shares of stock than cash. And so you'll record whatever you're getting for the stock at the fair market value of the assets that you're receiving. If you don't know the fair market value of the assets, then you'll record the assets at the market value of the stock. And usually it's pretty easy to know the market value of the assets that you're receiving. You can get an appraisal if you're buying a piece of equipment. If you're paying your lawyer's bill, you know what the lawyer's, common billing rate is. So that's usually easy to find out. And if the company's not publicly traded, it's typically pretty a lot of work to determine the market value of the stock. If the stock is publicly traded, it's easy to see. You can just go look at what the stock traded at the close of trading at the end of the day. Let's say we issue 10,000 shares of $10 par common stock to buy land. And let's say the land has a fair market value of $200,000. So if that's the case, we're getting land, we'll debit land for the $200,000. We'll credit stock for the 10,000 shares times the $10 par. And then the difference is going to go into that paid in capital in excess of par. If the land's fair market value wasn't known, then we would record the land at the market value of the stock, the 10,000 shares times the $17 market value.